short Pfizer.
$430,000 in 1 month, Jordy? Huh?
They're business expenses, yes.
Jordy, look what you got here.
What?
Look at this. $26,000 for one dinner.
No, this could be explained. Dad, we had the Pfizer clients.
Right, the porterhouse from
The
Argentina.
expensive champagne, the wine. We had to buy champagne. And you ordered all the sides. Tell them about the sides.
I
you
ordered the
ordered.
sides, so...
Sides? $26,000 worth of sides? What are these sides? That cure cancer?
The sides did cure cancer. That's the problem. They were there. That's why they were expensive.
Shut up.
And this is what I really think, like, I mean, it's been so interesting with going on lately with whether it's Elon or this or that, and everybody, you know, Rand Paul and them all kind of talking about it, is there is kind of this very interesting dance that's going on now because, you know, the United States is on an unsustainable path. I think everybody can agree that the amount of debt that we're acquiring, I mean, whether just the interest on our debt now is bigger than the defense budget. And the defense budget is the size of like some of the biggest countries in the world's economies. Like it's just numbers that are just on insane scales. So that's definitely, whether it's 37 trillion or whatnot, like that needs to be addressed. And if we don't, then we have to just keep borrowing and keep borrowing and borrowing. And that affects, you know, interest rates, and that affects, you know, the economy and stuff like that.
Look, we have to get our spending under control as a country. And if we don't, there's going to be a price to pay at some point.
All right. We have Mike Naidrich on today. Welcome to the podcast. And so as we get started off here, one of the things that I always do is I do an intro. So I'll walk you through. And so we have Michael Naidrich. He's co-CEO for Amerivet Securities. He began his career with NDB Capital Markets, where he rose to be the head trader until they were sold to Deutsche Bank in 2000. Afterwards, he went to Nova Capital Markets to run their trading operations. He received his bachelor's from the University of Maryland and is a graduate of the Harvard Business School's Advanced Management Program. Just so for anybody who's starting to watch, if you click subscribe or the like button, as this helps the algorithm, you know, for future, so you'll be notified when there's future podcasts. All right, Mike. So we'll get started. And so one of the things, you know, definitely would like to is what's your background? Where'd you get started? Where'd you go to school? And how did you end up getting involved with Wall Street?
Yeah, so Andrew, great to see you, and thanks for inviting me. I think you're onto something great here, and you know, really appreciate you taking the time to speak with me today. You know, I'm born and raised in Central Jersey, a town called Manalapan, New Jersey. Had the good fortune to go to the Petty School, which is a prep school in New Jersey, where I played some ice hockey. My travels took me to upstate New York for the beginning of college to a school called Clarkson University. And then after a couple of years, I transferred and graduated from the University of Maryland College Park. And interestingly enough, I studied journalism. I did not study to be into finance or business really in general. But when I was at the University of Maryland, I was bartending at a pretty busy bar. And when I was looking for a job, I got the good fortune of visiting a NASDAQ trading floor. And when I went there, being an athlete and being competitive and looking at the environment of the trading floor back then, I loved everything about it. It was action-paced. You won and lost every day. It was a competitive environment. And I said, I think this is the right place for me. So I found myself almost falling into finance at a very young age, and you know, stayed at Sherwood, which became NDB, and the name changed in the latter years. Ran the trading floor and until we sold to Deutsche Bank in, you know, I think it was 2001, which is literally a generation ago. So fortunate enough, and, you know, went from there to the floor where I was thinking that I wanted to continue to round out my market, you know, capabilities, and not just the NASDAQ, but the New York Stock Exchange on structure. And they were going through a lot of changes there because it was becoming much more technology driven with direct access. And then in like 2007, I fell into this veteran-owned space, which is where I've been, you know, for the last 17 years. And 8 years ago, I started with a couple other guys, Amerivet Securities, which is a service-disabled veteran-owned business. purpose-driven for-profit, which I think, in the latter stages of my career is something I enjoy very much. In, taking these enlisted veterans and, teaching them about finance where they may have not had that opportunity before, and these wonderful folks that have served our country very proudly. So very grateful for the experience, ups and downs along the way, but 33 years later, here I sit. So thanks, and looking forward to our conversation.
Yeah, no, and I think it's something like pretty important to point out that I don't know that everybody kind of sees is that the all of these guys who were, involved in the war and stuff like that, and they gave for their country and super patriotic. But when they were coming back out of, when the war was winding down, they really were kind of left in this empty zone and trying to figure out for themselves how to make it, and where their skills translated over. And it's great to really kind of see firms like Amerivets and stuff like that, where they're taking on and hiring those guys and realizing that a lot of those skills can translate over. So that's definitely
Yeah,
definitely been a
I
really big
mean,
positive.
Andrew, just think about it. They're some of the most loyal folks in the world. They're courageous. They're disciplined. They're the ultimate team players. And for a lot of the folks, and look, the academies are amazing schools, right? But they're target schools. They're very desired to go work on finance. For the enlisted folks, they don't have the relationships in finance when they come out. So what a lot of them do is they come out of the military, they use the GI Bill to go to school, which is an amazing program. And, we've reached out to universities and really have, dove deep into the relationships there to find and source these folks and give them the opportunity and to introduce them to Wall Street. And, there's many on the street, a lot of the big banks, you mentioned JP Morgan, all the big banks, Bank of America, Citigroup, Wells Fargo, I can go on, Goldman Sachs, I can go on and on and on. They're very super vet friendly. And what you've seen over the years is, the way we look at it at our organization is we want to make systemic change. And systemic change can only happen a couple of ways. Of course, you have to put money into it because you always have to put resources into it. But you have to give people the vision to see folks that look like them in the seats that they aspire to get to. And, you look at my co-CEO, Steve Kay, incredible story, 17 years old, has his parents sign him into the military because you have to be 18, goes into the Marines, comes back, and he uses the GI Bill to go to Pace University, starts an internship with us, at the other shop that I was at. And, when I came over to start Amerivet, he was the first call I made. And now he's the co-CEO here 8 years later. So, when they see that pathway, it really does change the way that folks see themselves, and maybe just as importantly, how others see them, because we don't let the excuse that people can't see the way their skills transition. It's on us to make sure that we figure out the way their skills transition, because these folks have earned it.
Yeah, that's definitely an important thing, and it's great that firms like Amerivets and stuff like that are really doing that. It's making a big difference. So, all right. So one of the things I guess is you were kind of initially getting started at the turn of the in the 90s, right? And kind of seeing the dot-com bubble and all that kind of stuff take off, and then you had kind of mentioned before about how then the stock exchange, it's funny when you talk to people, they still kind of have this view of Wall Street back in the day, and everything on the floor of the exchange, and that's kind of really changed a lot. We know a lot of people, friends of mine, their parents and stuff like that, everybody used to work on the floor, people used to have seats on the exchange, and now it's nothing like that. There's way fewer people down on the floor and whatnot. So were you initially you're working down on the floor back when it was?
Well, so originally I was on the NASDAQ trading desk. So the big difference there is on the NASDAQ, you had many different firms that were called market makers, and you competed with the other market makers, and you all had your own order flow. So the order flow wasn't centralized, where on the floor of the New York Stock Exchange, it was all centralized into a specialist book, right? And, sometimes I feel like in some way it never happened because it's so different now. But if you came to the NASDAQ trading floor, or you went to the New York Stock Exchange in, the 80s or the 90s, it was a busy place. Yes, there was some technology, even more so on the NASDAQ side than the New York Stock Exchange side, but there was a lot of people. There was a lot of what I'll call organized chaos, yelling and screaming, but, hand signals on the floor and, everything almost like its own language, right? So I think the way you look at it is that, markets evolve, technology comes into place. So, there's very few NASDAQ trading floors even left. They're much smaller. The risk that those desks take are almost non-existent relative because the spreads have narrowed so much. So there's no there's no really upside in taking that risk for your clients anymore. So they all trade in the algos and the ECNs and whatnot. And if you look at the New York Stock Exchange, which is a great historic building in really our country, the amount of people there is completely different. A lot of that is now technology driven. They're still a specialist, but they're much more sort of order flow driven than risk takers. Not that they don't take some risk, because they do. And they've turned it into a place where CNBC does their shows, and it's still an incredible building to go to, and people still are fascinated by the concept of going to visit the New York Stock Exchange. But all that being said, it's not the central place anymore where business gets done for trading. That's they call it now upstairs trading, which happens in desks upstairs through technology platforms.
Yeah, I mean that's what I mean. It's one of the things I really, I think for the normal person to kind of understand and see is that, how much really has changed, and that the floor is now kind of like you said. I mean, there's a handful of people walking around, but it's nothing like it used to be. And now, you have firms like Citadel, for instance, has become just an absolute monster in the
Yeah,
market.
they're a behemoth, right? And basically the key to being a market maker is to try to get as much order flow to come through your pipes as you can, so you can make informed decisions, right? And Citadel is definitely one of them. What an amazing business that they have, and they take risk across all products, right? So it's a very it just evolves, right? And and you can't expect technology to come the way that technology has come into the marketplace and not understand that human beings will not be at the focal point of that anymore. So again, in some respects, glad I lived it and glad I saw it and glad I was a part of it. But also at 54 years old, just look back at it fondly, because the new world, if you try to live in that world, you won't exist anymore. You have to reinvent yourself.
Definitely. I mean, and it's kind of, I grew up listening to guys like you guys, and, seeing all everybody who, went from the floor and were, when the spreads were way wider and people were making really good money,
Hmm.
doing that, to now it's kind of, crazy when I was trading, where the the systematics and stuff like that, where now everybody is trying to basically have an algorithm do most of the trading. And so, kind of to your point, it's kind of the market is just, the street in general, the technology is advancing so fast, and everything is kind of, it's funny because I basically see it now for me, what's pushing so many traders out, where, we'll get into it, but like when you would turn around and trade, high yield or IG and stuff like that. And now where, initially, you might be trading still over Bloomberg, 1 million or, stuff like that. Now the algos are doing, if it's IG, they're sometimes doing up to 3 to 5 million through the algo. And so you're,
Yeah,
really,
at least. I mean, you can pair off even bigger than that if you go from fund to fund, right? At certain times, they have the matching in the algos. I think look where it started, right? Spreads were big, and these algos, whether it was ECNs on the equity side, and or you look at you know market access or TradeWeb, some of those systems, right? The spreads narrow, right? And Therefore, you have terms like best execution and transparency come into the marketplace, and best execution is a real thing because that's regulated by FINRA and the SEC. So everyone, whether you're on the buy side or the sell side, is obligated to meet best execution. So it almost becomes a self-fulfilling prophecy that these algos and these technology providers will become the place where the marketplace um, evolves to. And in all fairness, I mean, you see it on good days and bad days. These things work, and people. There is human beings on the other side of these things putting in orders, right? So let's not make like they're all robots, because they're not. But it's very interesting to see the way it's evolved and the critical mass and the liquidity, because the key to it is liquidity, right? It doesn't matter how good your algo is, and it doesn't matter how good your systems are. If you don't have the critical mass of liquidity, then you're not really relevant, no matter how good the technology is. So it has to have the liquidity.
Well, and I think we saw that early in the year or maybe it was a little bit late last year and then early into this year where, when we talk about like, you're talking about putting the real orders in and stuff like that. Well, a lot now, the street, I mean, you have your real money guys, your Wellingtons, your Pimcos, your stuff like that. And they're, for a little bit, they actually were kind of stepping back. And, a big part of the liquidity was actually just being provided by systematics trading against systematics, as well as, the desks trying to take some risk and stuff like that. So the liquidity is a big part of it. It's just quite interesting how there still is discretionary. There still is the real money aspect of it, but there's also just gotten way, way bigger. The systematic side of it, where
Yeah, and by the way, but this is not new, right? So this has been going on for, in the equity side, it's been going on for, close to 3 decades, right? And the truth is the fixed income market was behind it, but it caught up, like I said, with some of the other systems out there, the market accesses and the trade webs. And, what's really interesting is what makes markets, and what makes markets is some people want to buy and some people want to sell, and sometimes you get extremes. And you know this, you're a student of the market. Markets run on fear and greed, and I think during the liberation time we saw fear, and in fear you get 25% downticks in the market, and then someone got greedy at the bottom of that or along the way, and next thing you know, the markets were up 30% from that low. So people got rewarded. And I think it's very part of human nature that investing in general, certainly trading, which is completely 2 different skill sets, as it's emotional, right? It's emotional, and it's very hard to keep your discipline when you have emotion involving these types of transactions.
Yeah, and as it's to make a point on that, so uh was basically early 2025, early this year, and the market went down because particularly there was some large tariffs and stuff like that. Trump's tariffs have definitely kind of created a bit of volatility in the market and a little uncertainty,
Havoc.
just a little bit. And but I remember when that happened, so many people, to your point about the emotions and whatnot, where for some people they're very good at stepping back, looking at the fundamentals, looking at the bigger picture. And then I had some other people I knew that were like absolutely freaking out and kind of, losing their shirt. And so one of the things I had kind of said was like, if you look at the bigger picture, this is, in general, what are earnings? Are companies doing better? Is this all the benefits to them? And you could see that this was going to be okay. Um, but
You say that, okay, and it has been okay. And obviously the S&P and the markets have snapped back. Actually, really almost V-shaped, right? And I think surprised some people there. But here's the thing I will say about markets: the markets can absorb anything, and I mean anything, right? They could absorb wars, and they could absorb terrorist attacks, and they could absorb a lot of things. What markets really have a lot of difficulty absorbing is unknowns. And the tariffs are an unknown thing right now, and they're starting to settle out. But if you want to, look back at 2.5, 3 months ago, there was a lot of unknowns. There was a lot of, and I think this administration likes the uncertainty and the unpredictability because they use that to their negotiating strategy, right? And it's not an endorsement, right, wrong, or different. I'm politically independent, right? But when markets get into unknown territory, that's why you see sell-offs like you saw when Liberation, Day was announced. And there was this real fear of the unknowns. And, it was, hey, wait a second, we're not just tariffing, China. Now we're going after Mexico and Canada, which, Canada is supposedly friendly fire, right? So you get into these unknowns, and then you get what I'll call an over-exaggerated move to the downside. And momentum works two ways. People forget this. People only think momentum works one way on the upside. There's also momentum on the downside. And then, you get into more granular stuff that, the professional world understands in our space, but maybe not the novice players or the the people who got their 401ks. Is you get margin calls and other stuff that expedites this selling pressure. And then you get the fear come into it. And, you get folks who've been around a really long time who start calling for calling for crashes and calling for this is what we've been waiting for, and this is the black swan event, right? All these terms that we all hear. And it's funny because black swan events are only defined after the black swan, not before, right? So so it's anyone could write history after it happens. Tell me the history before it happens, and there's some value there. But it's scary times, and one thing, and this because you're a student of fixed income markets, and it took me a while to mature enough to say this, being an equities market guy for a long part of my career. Is look, the equity markets matter because that's when people open up their 401k statements or their TD Ameritrade accounts or whatever it may be. But the real markets are the debt markets, and
100%.
and the credit markets, and one of the scariest parts that I saw is the credit markets were starting to not be open for a little bit, and that's when I thought.
When was this? Is this the beginning of the year?
Yeah, like right around Liberation, so was that like March-ish, maybe, like, when after he put the tariffs on, and, the markets they weren't closed, but they certainly weren't flowing like they've done for the last few years. And you closed
the spreads widened out. The spreads, I think they've gotten to as wide as 6%.
Yeah, so the spreads widened, right? So you had that. So the cost to issue debt was more expensive. The investor psychology had stopped. So, in January and February of 2025, we're only talking 6 months ago, most of these IG deals, for these highly rated IG companies in the Fortune 500, they're like 12, 13 times oversubscribed, right? I'm talking about big deals. I'm not talking about little deals, right? And then all of a sudden, people are trying to get their issuances done, and, they're 4X and 5X. And we even saw a couple, like, we saw something this year that we haven't seen in a long time, go, no-go calls on issuances, right? That's a real thing. And there's a lot of people on my team that never even saw a go, no-go call because the market was so, fluid for a while. So, I think Secretary Bessent probably, and I don't know this factually, but I try to keep myself aware, I think he deserves a lot of credit for, keeping the administration and its leadership in check and making sure they understood you don't want to mess with the credit markets. You can yo-yo the equity markets a little bit, and people can figure that out. You get the credit markets at a stagnation period. You're asking for something you don't want. And I think, thankfully, last quarter, which they're about to report now, the big banks reported, and they came out with some pretty large issuances, and they were pretty well subscribed for. And I think that opened the markets back up. But that is not something you want as a citizen, nonetheless, as an investor, just so we're
No, and I think you hit the nail on the head before with it when you talk about the uncertainty, right? That's one of the things, is like, you're 100% right that the uncertainty is what causes a lot of that issues. And like you said, even with the credit issuances and stuff like that, where when the companies are, when they don't have a pathway where they can see, hey, I can borrow money, easily till this amount of time. And when they know what the playing field is, it's a lot easier for them to operate. And the
Yeah.
uncertainty is what really makes them pull back, sit on the sidelines, et cetera. So
Andrew, I mean, be a CEO of a company or a board of a company and try to tell me how you're going to make investments when you don't know what the tariff situations are, right? So if you pivot out of China because you think there's a geopolitical dissent between, the two countries, and you go to another country to, you know, make whatever you make and produce, and then all of a sudden, out of nowhere, 40% tariffs come into that country, and you thought you were doing the responsible thing by pivoting out of China, right? And now you're in a worse situation than you even were before. So it is unrealistic for these CEOs to plan, right, not knowing what the tariff situation is.
well, but so this is the part. So I want to say this was probably 8 years ago. When I started over at Blackstone,
Mhm.
and we had our class was, in coming in class or whatever of the year I came in was, I don't know, we had maybe 100 plus people in our class. And this was when Trump was putting on the tariffs and stuff like that in the first place. And if anybody's watched Trump, he's been talking about tariffs since the 1980s. Whether back then it was Japan that was the talk
Yep.
of the
I
town,
remember.
and now it's China, right? So again, if you're studying history and stuff like that, people, yes, he likes to have that, ambiguity and that, keep you on your toes. But the part that I mean, when I was at this thing with Blackstone, nobody in the class, we had a bunch of the heads of the firm come in, and one of the guys who became like somebody I really like, and I got to spend a bit of time chatting with, was the chief investment officer for Blackstone. And one of the things that, at the time, everybody was against tariffs, blah, blah, blah. And I said, if you step back and you look at the big picture, and this is the part where I think it still kind of ties into what we're saying, is that everybody's still trying to play this, well, 10%, well, 15%. Take a step back and look at the big picture. The big picture, and I think Trump has been saying this for a very long time, is the entire system has been set up unsustainably, right? So the entire system has been set up where the United States basically subsidizes the world. So if you go off that aspect, that this is what's happened, and now there's going to be a complete shift away from that. I'm not saying that I know whether or not, one country is going to get hit with 10% or 20% or whatever, but you got to go in knowing that the entire system is going to be flipped. The United States is no longer going to be charging 2% while everybody charges us a 50% tariff. It's now going to be reversed. And if you go off that premise, my take is that it shouldn't be so shocking to the street. Trying to pick whether or not he's going to put a 10 or a 20 or whatever, just know the system is being reoriented. You're going to see that we are going to be now the ones, instead of India having 100% tariff, we're now going to be the ones that have the higher tariff, and stuff like that.
And I'm not here to argue whether that is correct or incorrect, right? There's people much smarter than me that maybe understand it more than I do. But here's what I will say. I understand how pendulums work, right? And if you're looking, I don't know if you could see my pen. So if the pendulum went all the way to the right, where the U.S. was paying way too many tariffs and not getting any reciprocating tariffs, at some point Trump's bringing the pendulum back. And let's just say, it's going to come somewhere in the middle. Trump's kind of going all the way to the left, and there's an extreme in that. So there's a reconstitution of how the world looks at it, how the people in the United States look at it. And anytime, and you know this because you've been enough involved with me in business situations, I'm a big supporter of evolution. I think when you revolute a little bit on the business side of it, there's going to be some shockwaves that go with it. So maybe because it's his last term, right? Because he can only have 2 terms. Maybe he feels the need, based on where the U.S. is right now, that he needed to take revolutionary acts on a relative. And I don't mean war revolutionary. I'm talking about actions, right? Fiscal actions. And he may be right in the future. But what I'm suggesting is, when you make that decision, whether it's right or wrong, and time will dictate right or wrong, right? When you put actions into place that are more revolutionary than evolutionary in process, you're going to have things that happen the way they happen. And it may be good. It may be good. I'm not saying it's not. But people do not like uncomfortable. People like status quo. Okay. And I think that, I agree with you. I've seen the interviews with Trump back in the 80s and the early 90s when he talked about how unfair Japan is. And he's been very consistent on that. Now, what I fear is that, as a fierce independent, and you'll probably hear me say that 3 or 4 more times throughout this cast, is that, that it may be right to do tariffs, and I can separate potentially the bombastic personality, some of the things that I don't prefer the way he goes about doing his business, but if it puts the U.S. on an equal footing or a level playing field for business purposes, especially with the Chinas of the world, I can separate the two. I fret because of the way he goes about doing some of his business that, people can't separate those, business decisions he's doing as the president versus to somehow they feel about him on a morality basis. And that's every person's right. And I can certainly see all sides of that as an independent.
Yeah, no, I mean, and we don't have to go down like,
Yeah.
Trump aspect wise,
Right.
but yeah, I mean, but I think that is an important thing is for people to be able to differentiate that. Yeah, sure. Yes, there's a difference between the personality and whatnot, but on a very big fundamental level, what is moving the entire world or what, like we were talking about, whether it's, for instance, the talk over, with the Fed and interest rates and the debt capital markets and, the debt for the country, which I think that's actually
Well,
something that's
that's something we should talk about. What is it, $37 trillion or something like that right now?
well, everybody talks about the 37, but nobody talks about it when they total up what each state's liabilities are too.
Yeah.
It's in the hundreds of
Yeah,
it's numbers that are
and
crazy.
how about the college debt crisis, which is maybe, even bigger than that. And so, on a personal level to the people, right, that they can truly taste and feel every month, right? You go to a university and you come out with $150,000 in loans and you're taking $600 of your paycheck when you're, into an entry level position, right? That's real money. That's real
Yeah,
money.
and this is what I really think. Like, I mean, it's been so interesting with going on lately with whether it's Elon or this or that, and everybody, Rand Paul and them all kind of talking about it. Is there is kind of this very interesting dance that's going on now because you know the United States is on an unsustainable path. I think everybody can agree that the amount of debt that we're acquiring, I mean, whether just the interest on our debt now is bigger than the defense budget. And the defense budget is the size of like some of the biggest countries in the world's economies. Like it's just numbers that are just on insane scales. But so that's definitely whether it's 37 trillion or whatnot, like that needs to be addressed. And if we don't, then we have to just keep borrowing and keep borrowing and borrowing. And that affects, you know, interest rates and that affects, the economy and stuff like that.
Look, we have to get our spending under control as a country. And if we don't, there's going to be a price to pay at some point. And I know there's many different, thought processes on that. But, I mean, COVID alone was another $5 or $6 trillion, I think, in the deficit. We need to figure out ways. I think where it gets tricky is, we've printed money so cavalierly in this country over decades. Okay, it's not a Trump problem. It's not a Biden problem. It's not an Obama problem. It goes back and back and back and back and back, right?
Big time, yeah.
And I think that what happens is that if you try to think about it responsibly, maybe like a corporation would, right? You make cuts, you have to do what you have to do, in order to survive, etc. It gets more difficult when you do it from the government level because you're going to kill a lot of social programs that people have become used to. And I think most human beings would want to have those social programs, right? But the challenge is, it's like having children. You would love to give your children everything. If you can't do it, you can't do it. And you have to get your family income in order before you can help, the house has got to be in order before you can help the children. And we have not shown a willingness as a country to make those critical cuts. And by the way, that could be military. That doesn't have to just be social programs. It could be military. It could be the size of our government. It could be social programs. It could be an array of different things. But the reality is, we live in a world where people have to get elected, and we live in this now, which is a very challenging thing. This internet world where there's sound bites, and people can want to make sure they're getting across what they want for the podcast or for the Instagram or the whatever it may be. And I think the will that it takes to solve these problems, which takes a lot of fortitude from leadership, is not there, quite honestly. And it's challenging.
It really is. And I think you kind of pointed out, for instance, the incentive structure is really not beneficial, because for a lot of these politicians, so all right, so you pointed out, for instance, that most of the issue, if people actually look at where the debt is, it's in Medicare, Medicaid, Social Security, and what you referred to as the entitlements. And, the defense budget's always been big, but even before COVID, we were going $3-4 trillion in debt, a year, and 75 to 80% of that wasn't actually even defense. Now, I agree that even defense, could be cut back quite a bit. Like, I mean, our defense budget is, I want to say there's 700 and something bases around the world. Like, I don't, we have a massive behemoth. I don't know that we need to police every corner of the earth. Like the old Risk game, we could probably step back and fortify a little bit. But in general, the big item is the fact that if you really want to cut it, you got to cut the entitlements. And like you said, I mean, that's a tough one, because how do these politicians, they go back and then tell all their constituents that are on the gravy train, hey, by the way,
some of it's not the gravy train, right? Like, you say gravy train, you're significantly younger than me. I have 33 years of paying into Social Security, hundreds of thousands of dollars. And I'm, 12 years away from, quote unquote, getting maximum benefits if I'm alive to see it. And I'm not sure it's going to be there. That's not an entitlement. I paid into that. You're a student of the market. Take Mike Naidrich paying into Social Security from 1993 on, right? And imagine if Mike Naidrich put that into the S&P tax-free, and what it would be now versus maybe not even getting that money. And by the way, personally, I have no problem paying Social Security. Never had a problem paying my taxes. I think we're very fortunate in this country that we live in a great country. And yes, we have our challenges, but if you look around the globe, we're still pretty good. But that's not an entitlement. I paid for that, right? And
but I think what people are missing, so if I would point it out, I would say is this, right? So one of the things that obviously Doge kind of pointed out was that on the rolls, you had millions of people who were
different point entirely, right? Yes. If we're paying dead people or fake names and all that stuff, that is a terrible mismanagement of the Social Security system. It is. I mean, in some sense, in a country our size, that stuff's going to happen. Okay, in a system that big, but that's completely different, right? I don't. There's some mixed numbers on the reality of that or not, and I'm not going to get into the politics of it, but that's fine. I'm talking about the person who honestly went to work for 35, 40 years, paid into the system to have Social Security when they retire. That is not an entitlement. That is something you paid into. That is no different than anything. Can you imagine if you I don't know, you paid to go to your gym, and all of a sudden they're like, "Oh, sorry, the gym is closed." Like, you'd be like, "What do you mean? I paid?" Right? It is fascinating to me. I can't believe that that money isn't there. I mean, I believe it because I know they tell us it's not there. But the fact that that money was ever allowed to be spent is
That's the whole thing, right?
it makes Bernie Madoff look like, nursery school, literally.
Well, and that's the thing is like when they tell you like, okay, I'm taking your money out of Social Security, they should take it out. They should put it in a completely thing and they don't and not touch it,
Yep.
right?
It should
But
have
the problem,
it should have never been touched. And look, if can you imagine the wealth in this country if you were allowed to, you couldn't touch it, all the same rules, all the same penalties, all the same things. But if you were able to put it into any instrument, with the, did you see the fascinating stat? Like, this is like, think about this, completely unrelated, but shows the power of the S&P, right?
well, this is a compounding, right?
Yes, compound interest, right? Recently, the owner's daughter, Jerry Buss, who bought the Los Angeles Lakers, I think in the 70s, right? Maybe late 60s, early 70s. His daughter, Jeannie, who's a very successful business person and management of the team herself, they valued the Laker franchise at like $10 billion, okay? Which is fascinating in itself, right? And she sold, their percentage. I think they're holding 17%. And there was a thing that said they paid $67 million for it and whatever, and they sold it for $10 billion. Not a bad investment, right? And then the next line was, if they would have put that same $67 million into S&P at that time, it'd be worth $14 billion. Right? So, you look at these vehicles, right? And I know like you could put in your 401k, but just anyone who has a 401k from the time, if they put in max 401k versus even what you'd get out of Social Security, if it is there, is fascinatingly different. You know what I mean?
Well, and this is the interesting debate that it's funny because I'm sure you get this too. Like when you work on Wall Street and whatnot, normal people will come up to you and they would, oh, what do I do? Where do I put my stuff in? Right? And the hard reality I usually have to try to tell people is it's not sexy. And then if you read up on Buffett and whatnot, he talks about this at endless for the last, I don't know, 60 years, is it's not sexy, but if you go and you just put your money in the S&P, basically you're betting on the market, you're betting on the United States of America. It's the largest 500 companies. Like, if you do that, you put your money in there, you don't chew your money up by basically doing a lot of trading, which creates a lot of commissions for the brokers and the dealers and stuff like that. And if you just put your money in there, and this is what you pointed out before, the difference between trading and investing. But if you were to do that, like you said, between the economy growing, you could also make the argument that, the Fed will always come and rescue, which pushes up the market even more. But in general, if you're in the S&P, probably the best place to be, and that compounding over an amount of time is put up a really good return, and it's pretty safe.
Well, on the for sure. Okay, look, I remember. You want me to date myself? I made a conscious decision. I don't know why. I just did that. I was never going to opine on the markets outside of what I do for a living, right? So if friends or family members ask me about the markets, I might give them general advice like you just said, but I'm not going to give them specific advice. I'm not smart enough to know whether markets are going to go to X on the S&P or not, when it's going to sell off and not. I do think the concept of using compound interest and dollar cost averaging into the marketplace, especially at a younger age, right? Because that money compounds for you significantly more than a later age, is a really good discipline and something that people should consider doing. This 2000, when I was literally living in the internet bubble, right? I couldn't go to a party. I couldn't go swimming without someone asking me about some .com stock, some this, I bought that. I made 30 points on this. I made 50 points on this. I work at this software company, this, it's the next this, right? And I would just very politely be, hey, that's great. Congratulations. Maybe give a caution of, hey, this doesn't last forever, but stay out of the conversation. Those same people, when the bubble, came to what the bubble came to, never told me about a stock, never told me about a position, never told me about how much money they made or lost. If they had their internet up to show me their portfolios, all of a sudden they would X them out when you came around, right? So, there's a
Well, this
long.
is your regular gambler who goes to Atlantic City or something like that, and they always tell you about their wins, but they
Yeah,
never tell you about the losses.
and look, there was a level of excitement to it, right? And this is when online trading came to the marketplace. You got to put it in concept of time. These folks never had access to the way they had access to the markets, right? And then the internet. People always talk about Reddit and all these things. I kind of chuckle a little bit. Reddit's not new. Yahoo Finance did that for years before Reddit ever existed, right? So, there's all these sort of things that happen and explains it in euphoria. And look, we talked about it earlier. It's always going to happen right now. You're seeing it right now. AI is like everything, right? And I think there's a whole bunch of people that understand AI, and I think there's a lot of smart people out there. I mean, in what world, Andrew, if I told you Bitcoin was going to be $114,000, would have you not taken the other side of that, and gave me, a quadrillion to one odds when it was trading at $20, right? Like, it's
1,000%. Yeah.
you know what I mean? So history will dictate a little bit the future.
But one of the things that like I really want to try to figure out how to do is, and I was having this conversation with somebody the other day, is to really for people to differentiate between the difference between, and you said it before, investing versus speculating, or and if people were to read it up on two people, should probably read up on Warren Buffett, and then on the other end probably George Soros. And the two of those guys took completely different approaches, but in no aspect would you turn around and say like with Buffett, you were 100% looking at discounted cash flow models, free cash flow, earnings of the business, management, etc. Where on the other end, you're trying to figure out, sometimes more from a trading perspective, of where is the momentum, where is the excitement, where is the, stuff like that going. And so I really think, for people, like you mentioned,
But
crypto,
it's I mean, investing versus trading, it's not even apples and oranges. I mean, it's like one is apples and one is like, ice cream sundae with fudge and sprinkles and cherry. Like they're not even remotely the same thing. The only comparison they have is they're both in the stock market, right? And if you look
the
at
average person, I'm sure you get this though. The average person like thinks when they like are going with crypto, they think that's like actually like, I
yeah,
don't know that they necessarily can differentiate. You know what I mean?
Look, crypto was a young person's game for a while, and then I think it went, some of the printing of the money and some of the other stuff. I think some of the professionals started to get behind it, and it's clearly been adapted as a currency, and people think it's a hedge against certain things like gold has been, and other things. I think, look, you look at literally the all-time best investor of all time, Warren Buffett. There's two things, and I have never met Warren Buffett. I've studied on him, I've read about him, I've watched him for years. Okay, there's two things about Warren Buffett that three things I guess I don't express about Warren Buffett. Number one is he will not invest in something he doesn't understand. So in the year 2000, 1988 to the year 2000, when every internet stock was going crazy, everyone was calling Warren Buffett, past his time, and he didn't get it anymore. And, and using words to describe him that honestly were quite out insulting, not only, I'm sure, to him, but to people who respected and studied him for years, right? And then, 2008 comes, or 2002 comes, in the internet bubble, and everyone's dying, and there's Warren Buffett, fine, with loads of cash, right? And then 2008 in the mortgage crisis, he puts on arguably one of the greatest trades that very few people talk about, which is buying Bank of America stock and getting preferred and making hundreds and hundreds and hundreds, if not billions of dollars on that trade with one of the best American institutions maybe ever. Right,
And
Bank of America,
and Goldman too.
right, and
He
Goldman. But
not also
Bank of America is like the golden child. But,
yeah.
but the third thing that I appreciated, I remember years ago, I was watching Warren Buffett's potential 3 proteges that were going to take over the firm when Warren was starting to think about giving up the day-to-day, so to speak. And this is when Charlie Munger was still alive and whatnot. And CNBC was actually interviewing them, and it was 2 gentlemen and a lady. And they were talking to them and said, what's the one thing that you've learned from Warren Buffett that you can pass on to our viewers? And they said, you cannot believe, and you know this because you're a voracious reader, okay? You cannot believe how much stuff he reads. And what he taught us is 95% of what we read, we will never, ever use in a deal. Okay? It is just consumption of knowledge and information.
But that
But the
5%,
5% we do will save us billions of dollars. By the way, that could be passing on a deal, not just in a deal, right? So that 5%, he goes, but he puts his hands on everything. And he invests in what he knows. And he's okay with missing, and he's okay if he doesn't understand Bitcoin, missing Bitcoin. And he was okay missing .com. And I'm sure, I don't know if he is or isn't, but he would be fine missing AI if he didn't understand it until he understood it, right? I mean, look, he does correct himself. He's been a large investor in Apple for a long time now, right? That's not so he does evolve with technologies and marketplaces, but, he sticks to what he knows, and he doesn't confuse himself, and his ego is only being successful to the Berkshire Hathaway shareholders, which obviously is the largest one.
Well, definitely. I mean, and that's and one of the other things that I thought was one of the great ones that he had mentioned was, for instance, he used to talk about kind of like a baseball thing, like whether baseball or hole punching. Like he was like, as a baseball, he's like, the best part is I don't have to swing at every pitch.
Yeah, that's right. That's
and
right.
so the
In fact,
reality, for a lot of people,
that's whether you're, and by the way, that's where it does cross over, right? Whether you're investing or trading, the ability to be patient and not, if and I used to say this all the time when I was running my trading floor. We had about 80 something traders. We traded 5,000 stocks. I was like, hey guys, the key is not your profits. It's controlling your losses, right? The profits take care of themselves. It's the losses. It's the ones who can control their losses. You get to play, if you want to call it this game, quotations, right? 252 days a year. No one says you got to play every day, right? You get judged monthly, quarterly, yearly, over 5 years, over 10 years. And I promise you that, in this case, it was a trading house. The trades you don't make will be the ones that you should really be talking about more than the trades you do make. And people don't understand that, because inherently as human beings, if we're there, like you say, if you're at a casino, you want to play. If you you don't want to go to a casino and not play. And the marketplace and market structure made it so easy to play, right? Back in the day, like not that long ago, we're talking about the 1980s, 85, right? We're talking 40 years ago. We're not talking, this is not some history lesson. If you wanted to buy 5,000 shares of IBM, it cost you like $400. You know what I mean? Like that same trade today, they do for free, right? So they made it a lot more accessible, and people, and then in the internet times of the late 90s, early 2000s, the money was easy. And anytime something's easy, you're going to get a critical mass of people to come to the game, right? Because the last thing you want to do is, there's some guy who makes X dollars and he's playing the market, and all of a sudden he buys a boat or he takes his family on vacation, and you're just this poor working stiff who goes to work every day, putting money in his 401k, paying his taxes, and then all of a sudden it's like, what am I missing out on? Oh, you can open up an account at TD Ameritrade also. And then he buys, MontanaDogDuty.com, and it goes up 10 points, and you get this sort of domino effect. And that's, God, I don't know if we want to get too technical with your listening audience, but that a short squeeze is the most aggressive you'll see stocks. You want to see stocks go up, put a short squeeze in a market, and we've seen that in GameStop and some of the others, right?
Well, and GameStop was one of them. And then to throw in another example that we all talked about at one point was, and he's always in the news, but Bill Ackman and Carl Icahn.
What a
and
battle that was, right? Legendary.
over Herbalife. And, he goes and, I think he learned his lesson, I think, on being careful where if you want to go and short a stock, and he may have even, when I did my due diligence, I don't know that he was necessarily wrong about Herbalife. But the problem is if you have two behemoths, like if, Icon and Soros step in and they go long the stock, you're
Yeah.
squeezing, you don't got a choice. And the farther it drops, you'll end up in a margin call.
Yeah, and listen, I know who Carl Icahn is. I've obviously have a lot of respect for his investing, legacy over the years. I happen to be fortunate enough to know Mr. Ackman a little bit. And look, what you learn there is, fundamentals don't always equal a stock going down, and fundamentals don't always equal a stock going up. And we saw hedge funds go out of business with GameStop, and they might have had every single fundamental correct reason of what we've read in books all these years and studied, right, on why GameStop should have gone down.
I mean, everybody knew that GameStop and BlackBerry were not exactly, these weren't your next high flyer tech companies.
But it doesn't matter. That's what markets do, because if markets traded to fundamentals, there'd be no reason for have a market. It would just trade to $12, and then earnings would come out and it would trade to $13. And there's a speculative nature to this, and short squeezes can create demand. That is, when you short a stock, in theory, your risk is limitless. When you own a stock, your risk is where you own it, to zero. And I've seen it over and over, years and years. There was a stock that I traded back in the late 90s called Solvex. Okay. And there was a guy named Dan Dorfman who used to come on CNBC, and he would talk about a stock. They would never do it today. And the stock would go up, 40% in about 13 seconds. And Solvex, the story was that Solvex took sand and turned it into oil. And I'm not here to tell you whether that's true or not true. All I know is I watched the stock go from $6 to like 50 in like 2 weeks. Okay. So, the power of, look, stocks work on demand, right? Supply and demand. And, and it doesn't always make sense. And, if you listen to Mr. Ackman, who, look, everyone has their opinion. I think he's one of the smartest guys on the street. He doesn't short stocks anymore. And the reason is he knows that there's a reality in shorting stocks that he can't control if the short squeeze, gets in, and then fundamentals mean nothing. And, shorts can put you out of business, where diversified investing over great companies that have great fundamentals over time, can provide you a very good return. Maybe not as sexy as shorting stocks. I love shorting stocks, but it's not, it's nothing feels better when you short a stock and it goes down. Okay. Something about that, but shorts can take a hell of a lot longer to work than a good long, and
That's what I was going to say. And that goes for the same thing for the market too, because there's been tons of times where, like, we all knew, like, oh, like you said, maybe the whole market's trading like way overpriced. Everything's at a 18, 20 PE, whatever. Like, there's times when even when you had everything with COVID, or in 2008, when, 2007, 2008, I remember people were going crazy about the market back in 26, 27. And what most people don't realize is, and at least from my study, it's often can take up to 3 years, could be longer, but it's usually somewhere around the 3-year time frame. But things can be irrational for way long. There's a great thing is
irrational markets will outlast your investment wallet 9 out of 10 times. Okay.
Exactly.
And there's so many indicators that people point to. If you look at now, even though the market's at all-time highs, money markets inflows are at like crazy highs, right? So that's usually an indicator that the market can go up because that means people are on the sidelines, right? I don't know. The future will tell us whether that was a correct indicator or not. And you can't see what I've learned, and I think what Michael Naidrich thinks or what Andrew Sabia thinks is not the thing. What I try to tell the young guys and gals that come to my firm is there's so much information flow that comes at us today, right? Information and disinformation. And by the way, information and disinformation was there for forever, right? That's not a new thing, right? The misinformation and disinformation, it was always there. What you need to do as an individual, especially in these times more than ever, find the people that you trust to follow, okay? Not everyone is a good follow. And by the way, my follows might be different than your follows, and people you respect and you think might be different. People have to remember, I've been a consumer of CNBC for decades, okay? And I think they've done a really nice job of bringing the markets to the public. But they're also an organization that has hours upon hours of days to fill of bringing on guests. And not every guest is a super knowledgeable guest, and not every guest has the interest of what you might have in the markets. And sometimes they go on and they talk their book up, right? And that's their right, and that's okay. But you need to understand the difference of that, right? So when someone's saying buy X company or Y company, that might be because that's what's in their portfolio and that's what they want to happen. And by the way, I will take them at their word that they really believe that. Okay, I'm not saying they're being deceitful in bringing it up, but I need to take it and I need to say, okay, who do I respect? So for me, when Jamie Dimon's on TV, for me, that is one I am going to hone in on and I am going to listen to. And it doesn't mean I believe every word he says. Does not believe that Jamie Dimon is all right on everything he speaks about, but I prefer his style. I prefer his honesty. I prefer his transparency. And I understand he's the CEO of one of the largest banks in the world. And, there's going to be a purview from that seat. But for me, I can take what I want out of that conversation. I, at 54 years old, can say I learn a lot from that conversation, and I will incorporate. Look, I'm a small organization. I'm not going to incorporate everything he says into my organization, but there's thought processes and there's logic and there's things that I can learn from him that I can do. There's others that come on CNBC. I will listen for entertainment. I will listen for prove or disprove my own theories. Okay. But I certainly will not listen to everything. And, one of the things I've been really fortunate, because I've been on Wall Street for 33 years, Bloomberg is a great source of information, and I'm able to find out everything I want to learn or know about and really can, dive in with as much granularity as I want. Or I do subscribe to the Buffett theory of absorbing information. And you'd be surprised how many times I will read something that has nothing to do what I do in my daily business transactions, but I feel much better served for reading about that or something about that or derive some lesson from it that I take with me moving forward. And the thing about learning in general is it doesn't always hit you at the moment, right? It could be 6 months, a year, 2 years, right? Where this kind of light bulb goes off or this epiphany where you go, oh my God, that's what I read 6 years ago, or that's what Jamie Dimon was talking about 5 years ago, or that's what Warren Buffett was talking about, or Charlie Munger, whoever it is, and I'm using big names intentionally for the audience. There's also a lot of other names. I mean, like, at my firm, I have a gentleman who works with us named Greg Farinello, who does, all things rates, Fed, and liquidity. And he's taught me endless amounts over the last 8 years about the Fed and how it works. And, because he's a student of that for decades. So why wouldn't I, learn from him and take my thoughts and my ideas and run it off someone who's got a lot more knowledge than I do, right? In things.
Well, and I think you hit the nail on the head. And I actually may have even gotten it from you at one point was, when I was reading a ton of books, and I don't know if it was you or somebody that I talked to and was like, don't always just read books about finance or don't always read books about that. Read books about everything. And like you said, it might not always, there's a lot of stuff that doesn't pay dividends right away, but in due time it shows up. And I've found, whether I was reading books about, whether it was sports, whether it was about scuba diving, whether it was about whatever, and that carried over into when I was learning about flying planes, when I was learning, there's so much stuff that
Andrew, you look at
carries over.
you look at some of the most successful people in sports or Wall Street, and they are huge students of military history, right? Like they study this stuff, and you're, to your point, it's not just military history. It's a lot of different things, and it makes them well-rounded, and it makes them understand people, and it makes them look. Trading is psychology, investing is psychology, and makes them understand people. You know, what is my favorite thing about that I've ever heard about Jamie Dimon? It's not that he's gone to Davos and he's opined on interest rates, and I'm like, oh, Jamie said rates are going up, so therefore Michael Naidrich now thinks, rates are going up. No, what I've heard, because I've worked with JP Morgan closely in this particular case, is when Jamie Dimon goes down into the building, he says hello to everyone and he interacts with people, and people feel like he knows them, even though he may not know them on a personal basis. And there's lessons to be learned, where you go into a building, and I've said this, you've seen me, you've been on these meetings with me, where I've literally gone to some of the biggest, corporations or banks in the world, and everyone loves to be so kind to the people they're talking to, right? And everyone's dressed properly. But, when they check in, you say, hello, I'm here to see whoever. And then you're leaving and you say goodbye and shake hands, and you're so kind to the people that you're talking to. And then you don't say goodbye and tell the person at the check-in desk to have a nice day. And I'm like, that's a character flaw to me, right? If I was going to do business with you, those people are working hard. Those people are kind. Those people are helpful. Like, why would you ever decipher the way you behave, whether it's the client, the person at the desk, the security guard? I don't care, right? Like, I just think there's a way you interact. And I think Jamie has, people feel a much more a part of what they're doing. And the key to it is it's genuine. It's who he is. He's not doing it because he's CEO. It's because of who he is.
Well, 100%. And actually, to throw one person in there, and I think they both really epitomize this, is both Jamie Dimon and Donald Trump. And the two of them are known for, getting down and actually asking the people who were doing the day-to-day operations, the people who are many floors below them, they come down and they actually ask them what they think. And there's tons of stories of Trump. I mean, I know directly from caddying and stuff like that. Like, he was building over at Trump National in Colts Neck. He was building this 19th green, and he was literally asking even caddies what he thought, what they thought of different stuff. And so he's one example, and Jamie's clearly another. Because the problem is, when you get so big like that, you often can get stuck in your own bubble. And when you're stuck in your own bubble, the people at the top, they don't want to ever tell you something you don't want to hear. And so you end up kind of in like an echo chamber, where the fact that these guys are able to break out of the echo chamber, I do agree with you. I mean, I think that's
well, here's how we say it at my firm, right? We have an opcom, right? And as an opcom, we have all these hypotheses that we sit in this opcom in the boardroom talking about on the strategic vision of the firm. And you call it an echo chamber. I'll LCD it. I'll lowest common denominator a little bit. I call it buying into your own bullshit. And it's very simple and easy to do when you're a chief executive or you're a senior executive at a firm to say, hey, I'm the CEO. I put the vision down, and what I say goes, and you start believing your own nonsense. One of the reasons, I travel 30 weeks a year, right? There's two reasons I travel. One, in a technology world, I want to still be a face-to-face person. I still believe in human interaction, and I believe in the importance of getting to know your clients both on a professional and a personal basis. Okay, I think it's extremely important. And the second thing is I am extremely fearful at 54 years old, almost 55, believing my own bullshit. So I want to take those hypotheses that I have in our opcom, okay, and I want to go out to my client base and I want to test those hypotheses and see what they think. because at the end of the day, they're the ones who pay the bills. And what I think is important, because I can set strategic vision, and in cases I can bring market structure changes to the environment and to Wall Street. But if my clients are not going to be an acquirer of that technology or my thought process, whatever it may be, Wall Street is infamous for having great ideas that go to the graveyard early, right? So it doesn't matter what I believe in a sense. Yes, of course it matters, but I have to go test that, whether it's internally with my team. Okay. That's why we go out for drinks. That's why we have lunches. That's why we do certain bonding things, right? Because you want people to feel comfortable enough with you to share their ideas. And I don't care. Yes, of course, Jamie Dimon's going to have a completely different level of respect at a JP Morgan where he employs hundreds of thousands of people. But whether you're Jamie Dimon or you're a small organization, for others in your organization to feel comfortable enough to share their ideas with you, and for you to be able to listen to them respectfully and to engage with them, and then maybe most importantly, give them the credit when it's their idea, okay, so they can continue to bring them to you, is extremely important. And, you know, a lot of folks, especially on Wall Street, because egos are, you know,
Huge. Yeah.
the flavor of the day and the night and the morning after. And there's a lot of credit stealers out there. And by the way, it's a skill set. There's a lot of multi-millionaires walking around that stole credit. Okay. It's just something I never understood as a person. And I'm sure many of the folk have gotten ahead and gone on to do, you know, what people would perceive to be bigger and better things than I've done. And I acknowledge that. But I think there's a right way and a wrong way to do things. And, you know, that's just the way I feel about it.
Yeah, I mean, we actually had that directly at the firm I worked for, where we had, I think what we boiled it down to was, you know, for people who are not as talented and they have trouble coming up with stuff, they like to steal off of the other people who've done that and toss people under the bus. I mean, it's the only conclusion I could come to, but there's definitely a lot of that on the street.
Yeah, and I'm sure in all industries, you know, this is just the ones we're exposed to. I just think that you can be successful and maybe not as successful. And how do you define success? I look, everyone likes to make money, and a lot of things that you're going to want to give your family, you know, derives off your success at work, right? But not at risking my character, not at risking my relationships, right? So if that means someone's going to be worth hundreds of millions and I'm not, I'm okay with that. And it just doesn't matter enough to me. Now, there's some folks that are so driven and, you know, so willing to play the political game and so willing to step over people. That's okay. That's the world. That's the world we live in. It just doesn't work for me.
Yeah, no, I agree. Same thing. And I mean, to give another Buffett quote, takes a lifetime to build up your character, and it takes all of about a minute to get rid of it. So
yeah, by the way, and in today's world, it's probably a second, because it can be on the internet in about 4 seconds, and you know, and
exactly.
you know, so
all right. So what's your take on what the Fed? Do you think?
Yeah. So and I got to give a lot of credit to my buddy Greg Farnell, who works with me, one of my partners. I think we're gonna tighten a couple of times here leading into the end of the year. I think, you know, it's not going to be as aggressive as Trump wants. I think Trump does play that game where he's like, oh, we should have, you know, 3, 4, 5, 6 more cuts. I think he'd like to see, right? But I think if he got, you know, 3 of those, he'd be happy.
Well, and I think he has a valid point of saying, like, okay, well, at least test it out, and if for some reason inflation kicks up, raise it again.
Yeah,
I think
look, this is again, and this is where, so, you know, you're getting a lot of my beliefs here, and I guess that's the point of the podcast.
Just to be free.
You know, I you know, one of my least favorite things is revisionist history. You and I have talked about this on a business side and a personal side, right? I don't like revisionist history. And Powell was absolutely late to raising rates. It is an undeniable fact. Okay. He was late to raising rates. I actually think he's done a pretty good job the last couple of years in his seat, right? I really do. I think he was definitely not good early on when he was late to the game. I think he was probably right for not lowering rates when people thought he was over the, let's call it the last year and a quarter, last year and a half. I think now it's getting to that point where, you know, lowering rates makes some sense. And I think what I would like to see is a little bit what you were just alluding to. All right, let's do a quarter point, maybe another quarter point, maybe a half a point. I don't know. And let's see where everything shakes out, right? Let's see where the tariffs shake out. Let's see where the job market shakes out. Let's see where, and there's two parts to the job market, right? Everyone always focuses in on unemployment, and that's obviously an important indicator. But there's also, like, people's income that matters too, right? Like, are people making more money, right? So it's not just unemployment. It's people's, are they making more money? Is it a employer's market, or is it an employee market, right? Like, there's a lot of different factors, but I think you're going to see two more cuts going into it. I think the only variable here is, and I'm really fearful of this, and this is where, again, politically independent, but what, I really think it's extremely important that we have an independent Fed. And I want that to remain independent. And I'm a big fan of the job that Secretary Bessent's done for our country since this administration has come in. I think he's one of the most important people in this administration, if not the most important after Trump. I don't want him to become the Fed chairman. I don't, and some of that is just a perception of that it is not going to be independent anymore. I think he's more than capable. Okay, just for the record, but
I mean, he's definitely. I mean,
yeah, he's as capable.
definitely
He's as capable as anyone, right? But there's some good candidates out there. If who knows, is Chairman Powell going to step down? Are they going to find a reason to fire him, right? Which they have to do only with cause, right? They can't just let him go. But
I think Trump's kind of pointed out, I don't know that they're going to fire him because he's so close to. If he had another 4 or 5 years, then
yeah, I think
yeah.
there's a little bit of icing the puck to his term being done, right? So I think that's correct. I agree with you. If he was newly appointed at the end of Biden's term, I think that might be something different. But the independence of the Fed is important, and I hope it remains that way. And I wouldn't be surprised, let's call it, over the next 18 months if you saw 4 or 5 cuts. But there's so many factors that play into that we'll see.
Yeah, and you know what? I think maybe we'll save it for another time because I think it's a whole can of worms. But I don't know how much I believe in the Fed being independent. I've done a bunch of reading from going back to Andrew Jackson, and when they got rid of the Fed the first time, they got rid of the Fed the second time, and I think there's a lot to the Fed. Basically you have a separate entity that's unelected that can control the entire monetary policy of the country. We'll save it. We don't have enough time to go.
Look, I'm not naive, right? When I say, do I think the Fed is completely independent? No, I don't. I'm not that naive, and unfortunately, with age, you get more speculative to certain things. But there has to be at least a belief that there is some independence, and I hope that it remains that way. And Greg has given I do a LinkedIn thing with Greg before. I think you've seen it before every Fed meeting, and he believes there's a couple governors out there that would do a very good job. And the reason I bring up Secretary Bessent is really because I just think he's actually the one voice in the administration that is very, very strong. I think he's willing to challenge Trump, and I think the one thing I will say about the leader of this administration is, he likes strong people, and he likes people who will challenge him, and he actually respects them. So, those folks are needed in any administration, and certainly in this administration. So, that's why I point to Secretary Bessent.
Yeah, no, I think he's been absolutely stellar, and I don't know that anybody's got anything negative to say about him. The other thing I just pointing out with the Fed, looking at history, is, and I find that this might also be a political issue, to be honest, because the Fed is also very political, is that if you go back and look at Greenspan, which was right in the epitome of your career and stuff like that, he was late on everything. He 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 stepped on the gas when, he shouldn't have. I mean, the whole famous the Greenspan put, right?
Well, the funniest part about Greenspan, and I don't know if you're too young to remember this, this is when, the internet started to come and CNBC started to become super popular. There used to be a belief that if he held his work bag in his right hand, he was going to leave rates, or if it was in his left hand, he was going to raise them or cut, so that's how ridiculous it got with him. But, look, it's a difficult.
It's not politically advantageous. Like, for instance, I guess my point is just like, it's the same thing. Like, it's not politically advantageous to be the one who's slamming the brakes on the economy. When Volcker did that, it's you're nobody's friend.
It's
when
not a
when
fun
there's a party
position.
going on.
Look, it can't be popular to be Chairman Powell when he's raising rates, as much as he did, coming off basically zero interest rates, right? Like, you're a heck of a lot more popular when rates are, free money or near damn free money. But here's what I will tell you about rates, and I'm not, again, I don't want to even slightly suggest I'm a rates expert. I'm say I'm rates aware for what I do in my job, right? I'm not saying rates should go down or stay where they are. I'm just saying rates where they are now are historically fine. My first mortgage in 1996 was 7.25%, and I didn't blink at it, right? But when people have 2.75% mortgages and 3% mortgages, and even people 3.5 years ago with good credit were getting mortgages at 4 1/8, right? So some of it is recent expectation of what rates should look like, right? Look at the rates they are right now. Corporations are still getting as much debt off as they want. The debt markets are as busy as they've ever been up until maybe the last month or so, right? So business is still being conducted at these rates, right? So it's not like they haven't been able to adjust to the new rates. I think that it's whether the current environment dictates whether rates should be eased a little bit.
I guess the one thing, and I have somebody coming on, I think in a couple weeks, who's a real estate guy down in Florida, and one of the things that we talk a bit about is just there's so many people. I think they say it could be 60% of the home market that is locked in at like 2.8, 3% rates, right? So
It's really a crazy thing. So if you own a home, and let's not even go, everyone always likes to talk about the bottom tick, right? So, someone has a 2.75% 30-year, right? What do? You can't sell that home. Like you can't.
that's what I'm
You
saying, yeah.
literally can't sell that home. By the way, even at 4%, you really can't sell that home. So let's use an example. Let's say you're one of the fortunate ones, and you bought a house 5 years ago in South Carolina, right? And you got somewhere in that 4% interest rate, and your home value has gone up 35%, right? What are you going to do? There's no supply. So even if you sell it up 30%, then okay, yeah, you make some money, and I get that, and that's all good, right? But you have to go live somewhere else if you don't have a second home, right?
And you got to go with financing at 6.5%.
6.5%. So who's doing that? Hashtag no one, right?
Exactly.
And then if you go in the rental market's ridiculous, right? It is cheaper at 4% to own $1 million home with a jumbo mortgage than it is to go rent, right?
And that's the point I've been trying to make to my friend, is like that I actually think that there is a potential where people are like, oh, if rates come down, then home prices are going to skyrocket. And I'm like, I actually don't think that's the case, because what I think will actually happen is if rates come down, that 60%, which is the majority in the market, will actually come on as sellers.
I think you'll see a much more liquid market if rates come down. And I think you'll see some people sell, and people will start to do the spread analysis of, can I take that? And okay, if my mortgage rate is, again, I think it's dangerous to use that extremes of sub 3. Let's just call it 4, right? That they're 4%, and then they can say, well, if it gets down to 5, then that's a 1% I can live with. You know what I mean? But
Well, that's the whole thing, is people could live with 1% difference,
yeah,
but if you look at the statistics, there's so many people who are locked in at, let's call it 3 or 4%, which is super cheap money. And then the whole thing is, what they need is, they just can't go out and go buy a new home and finance it at 6.5, 7%.
no,
So
it-
you need those rates. If those rates, like you said, maybe 100 bips brings a lot of supply onto the market, but
uh,
it's got to come
I
close
think
to
I
it.
think it will create some supply, and I think that's a good thing. But again, it's a challenge. Like, I don't know. I don't know what I would do. Like, like, I'm a good example, right? There's equity in my home, but like, to me, it's like, I almost look at it as, okay, if we get a price reduction, at least I'm still ahead above water, right? Like, and plus I think people, it's a little different, in 07, 08, when we had the mortgage crisis, you had people buying second and third homes. These mortgage companies were very, very lax with their processing of who they were giving mortgages to. That's become a lot different, with the benefit of learning and whatever. And I think that, people look at homes differently. Like, yes, they're an investment, and of course you would like to have them go up over a period of time, right? But it's also where you raise your family, right? And it's hard. You have kids in school, or you can't just. It's Yes, it happens all the time, and you saw it more in COVID because there was political reasons that people were moving from one state to the other state because of the way they handled the COVID protocols. But to take your 10-year-old out of school, or your 11-year-old out of school, and move them from one state to another is a very dramatic thing for your children, right?
Yeah, just in
It's not
general, homes need
it's
to
not
be.
just financial, right? It's a little bit more than that.
Yep. Yeah, I mean, and just to close out on, like, that's a home in general, and I think hopefully people are seeing it more, is, like, again, it goes back to the beginning of our conversation. Like, that's not one of the things you necessarily want to speculate on. And for the most part, you should look at it as raising your family, having one. If you can afford to have another because it falls within the means and you want to
Yeah,
have a
that's
summer
that's
home or
different.
something.
If you want a beach house or whatever you're going to do, and whatever, and that's fine. But you look, you're one who looks around in investing, right? And have looked at stuff. Some of it's a math problem, right? It's a calculus, right?
100%.
And what I found is, and I was recently having a conversation with one of my employees, and they were discussing whether to buy a single family home or a two family home. And the idea was they would rent out the two family home and build up some equity and all that other good stuff, right? Which is a wonderful idea. And I was fully supportive of the mindset of doing something like that. But because I adore this particular person, and I would do it for anyone, but like, I was like, hey, what happens if you don't rent it? Or what happens if you can't rent it for the amount that you think is going to cover that premium, right? You have to. And by the way, there's also this thing called, you're now going to go chase rent. And what happens when the air conditioning goes, and what happens when this happens, and there's a real reality to the math of all that. I think as human beings, we like to be optimistic. So we always go, oh, isn't this great? I get a two family home. My mortgage is $4,200, and I can get $2,100, and now I have this $700,000 place, that I'm building equity in, and they're paying half my rent, or half my mortgage, excuse me. And it seems all great, right? Until you're not renting it, and now you have double the size of a home you don't need. You have a place that your income does not allow you to pay, right? And then all of a sudden you get a new renter, and then you have to give the first month free, or you have to make upgrade. It goes on and on and on. And by the way, believe me, you're talking to a guy who probably wouldn't be on this podcast talking to you about what we're talking about. That if I had any hindsight in the year 2000, when I was a younger man and was making some nice money, I could have bought all of Asbury Park. I could have bought all of Long Branch for about 8 cents on the dollar.
Yeah.
and I didn't do it. So, I understand there's two sides to the coin. I'm just saying it's very hard. It's hard enough to be good at what you do, right? And understand what you do. Nonetheless, to now get into another business that, you don't even really understand it as well, right? There's a reason there's property management companies. There's a reason there's real estate investors, right? There's a lot to it. And I just think nothing, if something's that easy, usually it's not that easy.
If it's sometimes too good to be true, it's too good to be true. And on one little thing that is just attached. So I don't know. I've been trying to get this book for forever,
Right.
and I know you would know. So the guy, his name is Seth Klarman, and he founded Bopos Group,
Mhm.
one of the biggest private equity funds in the world.
Mhm.
He's got a great book, and it's called Margin of Safety. And just to tie it into that is that, Buffett talks about this a lot. Ben Graham, who taught Buffett, talks about this a lot. And it ties right into what you're talking about is, when I look at a property, I don't look at it, it's great if it's making 70, if it's 70% occupancy, 80% occupancy, but that's not a reality. And for most people, you got to go in realizing, will this pay the bills? Can I break even if I have 40% occupancy? You know what I mean? Or 35 or something like that. Can this withstand?
It's the downside. It's always the downside. It doesn't matter if it's trading. It doesn't matter if it's buying real estate. It doesn't matter
VAR.
any of it. It's downside risk, right? And if I, as we end here, and this has been wonderful, and I appreciate, you having me on. If I could, impress one thought on anyone, whether it's trading, investing, speculative investing, anything in your life, downside risk, protect the downside, understand the downside risk, protect the losses, and the profits will take care of themselves. People are too optimistic and just always thinking about the upside. And, look, whether you buy Bitcoin at $5 or 20,000, everything's relative, right? It's what is the risk to your overall portfolio? And for, someone like Michael Saylor, to invest in Bitcoin versus Michael Naidrich, those risk profiles are completely different. And he has an understanding, and he's executed wonderfully on his Bitcoin strategy, right? And I applaud him. Doesn't mean I understand it the way he understands it. And people need to know and understand their strengths and their weaknesses. And there's a lot of people that have gotten rich buying stuff that people had great ideas on that they were forced to sell because their life circumstances didn't allow them to have the ability to stick it out, that others came in and scooped in and made a lot of money on. So, just you have to know your own strengths, right? And your own ability to make sure you can wait out whatever downturns there are in marketplaces, because they're always going to happen. Always.
Yep, 100%. So, well, I just want to thank you so much for coming on,
Yes,
and
sir.
I appreciate your insight, and yeah, so that's great, and hopefully we'll do another one in the
Yeah,
future.
I look forward to it. I'm happy to jump on at any point in time. I think this is a great service you're doing for your followers. Look, I think what's important, for any of your guests from the viewer's point of view is, create their own viewpoints, but if they can gain some knowledge from people who have had the experience of doing it for a long time, that's great. But you still have to put your own brain power around what others are suggesting to you.
It's exactly just for everyone. Consume as much information as you can,
That's it.
listen to as many people as you can, and then make your own
There
decisions.
you go. You got it, bud.
All right, take
All right,
care.
Andrew,
Thank
be
you.
well, man. I'll speak to you. I have to go to a meeting.
Sounds good.
All right,
All right, bye.